setting new standards in podcast excellence. You have joined the WBT, fully focused on business and taxes. Here is your host, Michael Lodge.
And welcome to the WBT. This is Michael Lodge. I'm glad that you've joined me. It's a beautiful day out. I think we're going to have sunshine today. At least I see sunshine coming through my office window. So that's a good sign. What is our conversation going to be about? Remember, WBT, Wealth, Business, and Taxes. Today we're talking about taxes. I'll be right back.
This is brought to you by Lodge & Co., a business and tax advisory firm where your success is our goal. Call us today toll-free at 888-681-1518 or visit us at www.lodge-co.com and learn more about what we can do for you. Lodge & Co., your source for sound business and tax services.
Gosh, I can't believe that we're just about at the end of the year. Late part of October, we've got November and December to go. I tell you, I don't know if it's because I'm getting older, but these years are going faster and faster. I feel sometimes like I'm running out of time. I really do. I have so much that I need to get done and what I want to do, and I have all these bucket lists that I want to check off. But I don't have enough time. The year is going by so fast because you get caught up in projects, right? You get caught up into these things along the side that you forget that the year is passing so quickly. It just seems like we just had New Year's Eve. And here we are almost at the end of the year. We're almost at the end of October. I think Halloween is this week. Then we have Thanksgiving, which is my most favorite holiday of the season. And then December, which is the most expensive. And then we go right into a new year. Amazing. Just truly amazing. So we're going to talk about taxes today. Gosh, I just finished continuing education on taxation because I have to do it every single year in California to be able to sign on tax returns and to give tax advice and everything else that a tax practitioner does. And I tell you, I had to go into some level of conversations regarding things that I never even thought I would even have to deal with. Whoever thought I would have to deal with marijuana taxation in the state of California? But there's a lot of different things that we need to discuss, okay? Now, one of them is what everybody calls a side hustle. And they always say, well, in the back of their mind, they'll say, well, I don't really have to pay anything. I don't have to pay any taxes on my side hustle. Do you realize that there's an estimated 45 million Americans that have a side hustle? They're doing something. They're either selling insurance, they're selling real estate, they're doing consulting, they're making stuff, they have very close to a hobby income. But there are people out there, and every one of them have to rethink their thought process on taxation. Because if you're doing it all year long and if you're making money, you're going to have to report that to the Internal Revenue Service. Side hustle money is not tax-free. You may think it is, but it's not. Let me tell you what happens in an audit. When you get audited, the IRS is going to come to you and they're going to say, listen, I need to see all of your bank statements. And they're going to add up everything that you deposited into your bank, and they're going to tie it out. But then they might even see, oh, well, there's other income coming in here too. What is that? Well, that has to be taxed. That's the IRS's view on things. But there are ways that you present that to the Internal Revenue Service when you file a tax return. That is through a Schedule C. And that Schedule C is for business or profession. And that is for your side hustle. That's where you report it. So if you made $20,000 or $2,000, whatever it may be, you have to report it. It has to go on the Schedule C. Now, you have expenses to claim against that because a Schedule C is really a profit and loss statement. You got your income coming in and your expenses going out. That supported that income production. But you can't hide it. The IRS at some point in time will catch up. And you've got to make sure that this side gig that you have is being reported. Otherwise, the penalties and interest on that is going to be very high, and you are going to be in a lot of trouble. Now, many people who have a side hustle are employed in an independent contractor capacity, which means that you're getting a 1099 MISC. So, if that's the case for you, it means you won't have taken any taxes out. No taxes are taken out on a 1099-C, which means that you are responsible for any taxes on that income. You need to keep track of your income, report it to the IRS when you file your tax return on a Schedule C. Therefore, if you typically bring home $500 a month from a second gig or a second, whatever you want to call it, a side hustle, assume that the entire $500 is yours to spend. No. Rather, set up some of that money aside for taxes. Set some money aside. Just put it to the side. 20%, 25%. And then use this cash as you see fit, but you have to realize that you are reporting an income. You have to report that as income. A side hustle is income. Now, a lot of you this last year thought, oh my gosh, I've really lost a lot in itemization. Well, a lot of you did lose it. If you were teachers, you lost a lot of that deduction you used to take in buying books and pencils and crayons and everything for your school. Home business expenses, operating a business out of your home, doing your work out of your home, using your car for your office. For your work. So when you file your tax returns, you get two choices. You can either go with a standard deduction or you can itemize, okay? Currently, the standard deduction is $12,100 for single taxpayers and $24,400 for married couples who are filing a joint return. Prior to the tax overhaul, the standard deduction was only $6,350 for single taxpayers and $12,700 for joint filers. Because today's numbers are so much higher than they were in the past, an even smaller percentage of filers are likely to itemize, but that doesn't mean it's the wrong move for you. You can still itemize. Example, if you pay a lot of mortgage interest, are liable for a high amount of state and local taxes, and give a lot to charity, then you may find that you are still entitled to deduct a sum that exceeds what that standard deduction is. Remember, if you're married filing jointly, it has to be over that $24,400 mark. If you're single, it has to go over that $12,200 mark. So if you have a mortgage and you have those property taxes and everything else, yeah, you're going to be cut off at some point in time, but you may have a little bit more to go over that standard deduction amount. So what's the takeaway of that? Don't assume itemizing is your best bet until you actually sit down, run the numbers with your tax practitioner. Now, here is something that people always think. I don't earn enough to get audited. Nah. Though fewer than 1% of tax returns are audited each year, your chances of landing on that list are actually higher if you don't report much of an income. Among tax returns filed in 2017, the audit rate was adjusted gross income between $25,000 and $499,999 ranged from 0.44% to 0.54%, meaning the percentage of returns were flagged, but the audit rate for income between $25,000 and $49,999 was a bit higher at 0.69%. And what are they going to look at you on? Well, maybe earned income credit. Maybe you're filing a Schedule C, and they want to make sure that those numbers are correct. Schedule Cs are a flag to be audited on. So you can be audited. It doesn't matter really what size of return that you're filing. It may have to do with certain things that you are taking as earned income credit or child care expenses. Those things are looked at and they're questioned. So it doesn't matter what size of tax return that you're filing. It has to do with certain issues that they may pull out just to question. So listen, the tax system in this overhaul was supposed to simplify everything, but really it did not simplify it. It made it a little bit more cumbersome because a lot of people lost a lot of different things that they could deduct in the past. And now they're really filing a short return, almost what I would consider a short return. And those who are itemizing, you don't have that much. You really have your mortgage interest, you have your property taxes, you have your charitable deductions. So you've lost all that stuff that you were making numbers up before. What you were making up before on uniform costs and work shoes and everything else that it seems like no one hardly ever had a receipt on. They were just making these numbers up, because I can tell when you're making stuff up. When I ask you, how much did you spend on this? And if you look up into the sky, you are grasping to the heavens for numbers. I can tell. And the IRS can tell too when they start auditing you. If you don't have the backup to support the deductions that you're taking, do not put it on your tax return. Do not put it on your tax return if you don't have the backup for it. Be conservative in the way that you prepare your tax returns. Don't be over outlandish like so many people in the past have done, where it was literally led to fraud because they overstated their expenses and they underreported their income. So you have to be very careful on how you prepare your tax returns. Listen, that's it for me today. I'm tired of talking about tax returns, but I'll be back in the next few days to talk about it more, because we're just about to that point where we're going to have to start taking tax returns. Start thinking about filing tax returns. Now, one thing before I leave. I want you to go get your pay stub, your latest pay stub, fax it into your tax practitioner, ask him if you've taken enough taxes out for the remainder of the year, and make an adjustment. If you have to take more out, take more out. But make sure that you've contacted your tax practitioner and ask that question, because you don't want to be owing taxes at the end of the year. You want to be just about right. A lot of people say, oh my God, this is the first time, this last tax season, this is the first time I've ever owed anything. It was like $500. Some maybe $5,000, depending on what they were doing, what they've done in the past years. But it did change. But listen, if you've just paid $500, you were pretty much right on the mark. If you got a $500 refund, you were pretty much right on the mark of what you were paying. Because remember, you were paying those taxes less throughout the year. So you were getting your refund throughout the year, because the tax rates went down on your W-2 income. So you got it, but you just got a little bit less at the end of the year. Now, if you think that you're going to owe, sit down with your tax practitioner, as I said, and go over the numbers. It's not that difficult. And he should do it for you for free, because it's part of the planning for 2020 tax season. Well, okay, That's it. If you guys have any questions, I want you to send me a text at 818-252-5682. I'll repeat it again, 818-252-5682, and let's talk about taxes. This is Mike Lodge. I'll talk with you very soon.
Thank you for listening to the WBT with Michael Lodge. Join us again tomorrow as we explore more about business and taxes. Follow us on iHeartRadio and go to our podcast website at www.wbtpod.com and listen to all of our podcasts and read our blogs.
This podcast has been produced by Michael Lodge, fully focused on content.